Happy Saturday and welcome to another session of our RM Smart Investing's weekly market analysis. It's so wonderful to be back. It's been a while, actually. It's the longest time I've been away, so I'm so pleased to be back with you. And there's a lot to actually catch up. Uh, but what I would suggest, if you don't have a lot of time, I will just pay attention to the first 5 minutes of what I have to say. And then, as I mentioned, we have lots of slides. I think I have almost 100 slides to go over. And it is September, by the way. So we like to look at the markets. As always, we look into the economy, what's going on, and what events are coming up, which could affect the markets. We will analyze the markets as a whole, look at the different asset classes. I got quite a few slides on emerging markets from different aspects of them. A few lessons of the week, the trade of the week, which is the gap trades, and then the screen of the week. So let's start. This is a slide I think it's important, and I'll spend a few minutes. And this is a gist of what we're going to talk about today. The main thing is, what event that the central banks pay attention the most, and the Fed is paying attention after the strong job markets we had, is the upcoming CPI and PPI, which is all the inflation numbers coming up next Wednesday and Thursday. And you have to remember the following week, the Fed has its two-day meeting, and they're gonna make interest rate decisions. Now, the way the market is looking at it, they feel that 92% chance and the Fed is not going to make any move. Right now, although the market is looking at that, I think that core CPI and CPI are going to be very important. So just be prepared for that. If you have a CPI trade, this is a good time to do that on Wednesday morning, which comes out about 5:30 a.m. California time. The second thing is I want to pay attention is the dollar. You can see the strength of the dollar, and obviously it's very much related to the interest rates as well. And it's kind of predicting what they're thinking. And so this strength in dollar obviously has affected the commodities, mainly gold and the euro, and also other currencies like euro. Also, crude oil has been on fire, and again, that has affected the energy stocks, and energy stocks have been a big winner, especially previous week. And so that's another arena we want to pay attention. And we look at some of the Canadian energy stocks, how that has helped them. Also, this week, starting today, actually, we have the G20 meetings, and we'll review what's going on there and actually what is G20. Also, if you're doing options trading, and even if you don't, we have the Triple Witching Friday coming up next week. So that's when, all the options and indices and equities and futures all are expiring. It makes the markets a little volatile, so just be aware of that next Friday. The other thing is September is here, so we are actually starting the we have already had this. This is the second, I would say. We had a short week. The third week is starting, and generally, as you know, September is the weakest month. So just be aware of that from the seasonality point of view, and we'll discuss that. The last but not least, if you recall exactly a month ago, I talked about the inflation and how that strikes, especially with the auto workers. We had the pilots, and because of the labor shortage, what we have, they kind of have an upper hand, and with that, what comes is the wage inflation. They're not giving up, and although unions are not as strong as they used to be, I think there's 11 and 12% of the workforce is unionized compared to like 30+% in the 50s. But still they have a power, especially in Detroit. And what is happening is they're negotiating September 14th is the deadline. And obviously with that, it comes the inflation pressure because wages are going to go up. And with that, again, there's that pressure. So make sure that you pay attention to that. So as far as uh, the, the other thing I want to pay attention, which is not talked a lot, is the government shutdown could happen October 1st. We've had about 35 of them since 1970. And that's something that, again, there's not much talk, but that is in the mind of the market. So as I mentioned, we had 35 of them. The longest one we had was in December of 2018, and that coincided with the higher interest rates. So basically, that's something that you want to be aware for the next 3 weeks, because that means that there's a fight between the conservatives and the Congress, and what's going to happen to the government employees. They're going to go on furlough. So anyway, so in a nutshell, I just wanted to share these upcoming things, and I want to pay attention. Now, with that in mind, so let's dive into what is happening and what has happened. First, we go into the economy. As always, I like to go under the hood, as I call it, and look at where we stand as far as the general economy goes. And as you can still see that the global commercial flights are strong. I mean, the flight that I took, let's say from Dubai to Los Angeles, it was completely sold out. It was booked. I had the last seat. Thank God I had someone, I had a fun couple of people sat next to me, and we had a fun time, but it's 16 and a half hours and completely booked. So you can see we are actually 7.7% over where we were in 2019. Other things, we look at the box office receipts, the movies, we are 28% below where we were 2019, but 52% month over month below where we were. Obviously, we had the Barbie and the Oppenheimer. There was a big hits, and we don't have those. So that's food for thought. Hotel occupancies are, again, now that September is here. We are a little bit behind where we were in 2019. So I mentioned to you, this is something you want to pay attention in upcoming week. Wednesday, we have the core CPI, and CPI month over month and year over year. The market expectation is actually 3.6% year over year, and the core is actually only 0.2%. And I talked about the energy and the oil. You want to pay attention to the crude oil prices, which we'll look at into their charts, see what's going on. The other thing is on Thursday, we also want to pay attention to the core PPI, the purchasing price index from producer's price index. This is from the producer side. Also pay attention to this retail sales. That shows the strength of the economy. We want to see how the consumers are behaving. So we want to look at the core and the retail sales. On Friday, we have a couple of small ones, and we have the University of Michigan consumer sentiment. As you can see, still strong. So that's also just be aware of their preliminary inflation expectation as well. As far as the yields, you can see the rates between the United Kingdom, with the Great Britain and the United States. The short-term rates are pretty much identical. The euro is trying to catch up, but they're still behind the United States. And then on the long terms, you can see again, there is UK actually has taken over, and they are ahead of us. But this is what we want to pay attention. The yield curve, you see, we have been flattening, but the spread is getting smaller within the 2-year and 10-year. So we're at about 0.73 or 73 basis point, but still there is a purchase of the long-term bonds, especially with major institutions, because the thought is we are at the end of interest rate increases, and basically in the long run the rates will come down. Especially a lot of central banks are on a pause. They don't want to increase the rates anymore for, perhaps selfish reasons, but the long-term end is actually improving. So that's something we want to pay attention. Talking about the long term, I shared this before. This is our 10-year yield, and going back to 1980s, and you can see from the high of 1980 and where we are, we're using the Fibonacci, and you see we are right at the resistance. This is not complete because we are only the second week of September, so the month is not over, but you see how this as far as the 23.8% or the 4.17 area has been a magnet. We are trying to get close to that, and we actually just went above that. Now once we go above that, that's not going to bode well for the markets, especially when you think about mortgage rates, when we think about housing. Right now, the way the Fed is looking at these things, they feel that still we are in the Goldilocks situation. And what I mean by that, they really enjoy that strong economy in a way of good labor market, and they can't believe raising over 5% in such a short time, and the market's still resilient. So if they have to raise rates, they're still going to go ahead and do it. So, but they have to really, it's a balancing act, and this is a crucial point in my opinion. All right, so let's go jump to the markets. The week that we had last week, as you can see, it was a down week. It was a short week. People are coming back from their holidays. It was a Labor Day weekend. So the Dow was down 0.75%, and NASDAQ was down almost 2%, and the S&P was down right in the middle between these two at 1.3%. You see from the highs of what we've had, the markets are down just a little bit from their highs, and as a whole, the whole market, United States markets, was down about 1.47%. Now, the big losers in this situation were the small caps. The small caps, when we look at the charts, you see they have been really beaten up, and mega caps are still a leader. We will look at Apple, but you can see Apple was one of the culprits of the down market for the S&P. And basically, one of the obviously the reasons was the China's insistence on the government employees and civil employees not using iPhones. So that affected. But when you look at the mid cap and when you look at the small cap, you see that has had a big effect. As far as the sentiment goes, you see this as a Wednesday, the American Association of Individual Investors. You see we are back to more of the bullish side. We are above the average right now, and also we are the below average on the bearish side. So for a couple of weeks, for 3 weeks we were in the norm, and now there's more bullishness coming, which could be contrarian. On the CNN Fear and Greed, if you recall, before I left, we were really on the greed side. There was we had a thought that yes, the markets are going to correct because there was so much enthusiasm, but now we are in the neutral. One of the things you will notice this week, it will be a theme once we look at the markets as a whole. There's a lot of neutrality. So the markets, although September is a weak month, you're not going to see a really clear guidance. So it might be a good time not even do a lot of trades for the next couple of weeks. the market is on a wait and see mode. They want to see what the Fed is going to do. And you will see the charts are telling us as far as like, especially in S&P, but also you see again from the sentiment, we are in neutral. Also, when we look at the Citigroup, you could see that in August, we really got close to the euphoria side. But since then, we've been correcting. We are in a more of a positive to neutral side right now. So let's look at the charts. One of our favorite charts is obviously we use the Fibonacci, and I still go back to the August of last year, 2022, when we had the highs at that time, and we hit the low of October. Now, this is interesting. Is before I left, the two things we mentioned right end of July, beginning of August, and that was we were at 127.2 Fibonacci number, close to that. We went above that, and we talked about the round numbers, the 4,600. We actually went to 4,606, but 4,600 was really the turning point. And guess what happened for the month of August? We turned in the first week, which coincided with the downgrade of the U.S. Rating. We went from AAA down to AA with the Moody's. And basically what happened, the market retraced. Look where it went, all the way back to the August high, exactly a year ago. And what did we do? We bounced back. And where did we go? We went back to that 127.2. Now, what you see is, as I mentioned, we are in a really neutral zone. So it could go either way at this time. We are sitting at the 50-day moving average right now, but we are under the 8-day moving average and right around the 21-day moving average. So it's flattening. So really, I don't have a clear direction at this moment, but you see, we've been kind of respecting our support and resistance at this moment. So when we look at, I just want to look at also the Heikin-Ashi and linear regression channel. Again, we respected, you can see in August, we respected our second standard deviation. And what happened? We had a nice bounce. So where are we now? We are right in the midline from our best fit data. You can see right in the zero line. So we are right sitting there, although the MACD has lost its momentum. Basically, once we lost, that was taking profits off the table. And also our TSI and once we look at the strength of the stochastics here, the momentum is downwards. But again, the slope is lower here on a daily, but not too much. So again, the extremes have been respected. Also want to look at it on a squeeze on a monthly basis. This is a monthly chart of S&P 500. And what you could see again, when we go back last year, our linear regression channel is respecting the standard deviation. So where are we on a monthly? Again, this is September monthly, so it's not conclusive at this time because we just started it. But again, we are in our zero line. So basically more of a neutral, although on a monthly, we see the slope is upward. One interesting thing is on the squeeze, you can see that we had a squeeze and it fired basically to the upside. But this fire is a suspect because, again, the month is not over yet. So I just want to take a look at from monthly. Again, you can see that how interestingly on a monthly basis, we respected our linear regression channels. One last thing, once in a while we look at the Hall moving average. So we looked at the daily and week on monthly. So I want to look at a weekly Hall moving average, which is much faster than our simple or even exponential moving averages. And you can see how nicely, in April, Hall came close to our simple moving average and then bounced back. So it showed us strength. Now, we've been staying above that on a weekly basis, but what happened to our end of July, beginning of August, we broke below that Hall, you look at the 21 week moving average, and we went right to the simple moving average and bounced back. So you see, again, we are right in the middle. So once we break above this, then that could give us a new direction that we could be long. But at this time, we are in a kind of a neutral zone. We don't have a sell signal, but we also don't have the buy signal. So let's look at our Bollinger Bands and look at our support. And basically, this is on a daily S&P, and you can see that the 100-day moving average has been a very good support. We did go hit our Bollinger Band, and it respected that, and we were on an overbought. So our stochastics was on overbought. MACD crossed it, but now we are in a really neutral zone. We are not gotten to negative, but the momentum is shifted down. We are right on 18. So once we hit the upper Bollinger Band and we are overbought, generally, as you know, we go to the next support, which is the 18-day. And if we break through that, we go either to the 100-day or to the lower edge of the Bollinger Band. So that's where we are. So the momentum is down. We are right on the 18-day moving average. So pay attention to this 43, 48 zone. Now, once we bounce back and the momentum turns around, then everything is nullified. On a weekly basis, also, you can see that we are respecting that 18-week moving average, and the momentum was down, but it has turned around a little bit. So on a weekly, we are in a more of a neutral to the positive side. We are respecting our support. MACD is trying to cross, so we haven't completely gotten the confirmation, but MACD is showing us the trend could be going down. And as I said, if once we break this, we will go to the 100-week moving average. As far as the NASDAQ, NASDAQ has, again, respected this 100-day moving average. We were embedded. Now we are, the momentum is down. So again, we hit the Bollinger Band. We are sitting right on 18-day. And Russell has been the weak one. It was very strong. And then basically what had happened is we just broke below that 100-day moving average, and the momentum is very much down. We're almost in oversold, and MACD is crossing. The same thing when we look at the weekly. Now, on a weekly basis, what you will notice, that 100-week moving average, it has been a strong, strong resistance. And in August, it did not fail us. We tried to be embedded, couldn't, so we broke down on the stochastics. MACD is about to cross down, and we just broke below the 18-day moving average. So what it tells us that the lower Bollinger Band could be our next objective. As far as the Dow, it's kind of a flat, we're in a no man's zone. The momentum is down. We are below the 18, but right on the 100-day moving averages. What it takes us to transportation, which is a leading indicator. And you can see once we started, we were embedded for the long time. And once the stochastics broke down, we went to the 18-day, we went to the Bollinger Band, Bollinger Bands expanded. Now where we are actually oversold at this moment. It could be embedded on Monday, and we are right on a 100-day moving average. So either this is going to create a support as short-term support, or once we fail that, we are going to get embedded, and that could go lower. As far as the VIX, now VIX has created an interesting situation for us. You can see it's one of the lowest we've been. We are, looking at, we've been ranging 12, 13, 14. Now, that does not mean that, the volatility is dead. It's just because of the setup, as you know, that the VIX is the 30-day options premium on S&P and all the options. But with the introduction of these one-day expirations, things have really moved much closer. Now we're looking at like a 9-day expiration, 9-day volatility. So once we look at the expected moves in the next segment, you will see that actually there is a lot of volatility in the short term. But when you look at the VIX, it does not present itself. Look at this. It's pretty much flat Bollinger Band open, but still in a negative sign, in the sense that we are in downward. We are trying to become oversold. We were embedded. So VIX, and then the volatility of VIX, volatility of VIX shows us that there is a volatility in VIX, but again, it does not bode well as far as the really true meaning of what is happening with the volatilities at this time. Now, this is our interest rates. You can see we've been on above the 100-day and 18-day. So interest rates, we hit a little oversold, and since then we've had a nice move up. So we really want to watch that. The markets are thinking, obviously, the strong economy is a justification for higher rates. On the other hand, you see the 10-year notes. They are really in a difficult situation. We are below the Bollinger Band, below the 100-day. We are just below the 18-day, and we are a little bit oversold. So we might have a little bounce, but the charts are not, they're not as positive. So we are here, as I mentioned, we are really waiting for the Fed and also the CPI numbers coming this week. The same thing is happening with the 30-year bonds, although with the 30-year, as I mentioned, there is more interest from the institutions to buy long-term bonds. So we are kind of consolidating at this time. You can see all these dojis at this time. And on a long run, basically you can see we are just going nowhere right now. We are embedded, so there could be a short-term bounce, but there is no buy signal yet. So we talked about interest rates. We saw that interesting move, and what it has guided us, that higher interest rates has been the leading indicator as far as what the dollar, or what the dollar is telling us, is that the higher yields are justified. Look at this big move. Now, if you recall, I think for the last 2 years, I've said the 100, in this case 99.75, is a crucial support for the dollar. Once we break that area, then all the bets are off, and that's where the dollar sell-off could happen. But we have been respecting that, and we did that again in July, and we had a really nice bounce. So you see the dollar has had a really nice bounce, but now we are kind of a little overheated. We were embedded, we went down, we are back. We are not embedded yet. We are above the Bollinger Band, so we might be getting a little overheated on that point. So that doesn't mean you're going to short the market. Just be aware that maybe it's time to take a little profit. And with this, what you will notice is on a weekly basis, we've had a really nice bounce again from this support area, and this again the 100 zone. We are right to the upper edge of, or the top of the Bollinger Band. So I think, and we are overbought, by the way, on a stochastic. So although MACD is giving us positive indication, on a short run, as I mentioned, we might need a little rest. When it comes The euro is the opposite. You see the euro has been under the 100-day moving average, under 18-day, and we are just hugging that Bollinger Band, and that's the sign of weakness. We might, again, have a pause here. We might have a little bounce, but we are not out of woods, especially with that strong dollar. That brings us to gold. Now, gold is in a kind of a weak spot in a sense because of that strong dollar, but also because of the higher interest rates. If the interest rates stay high, as we have seen, then that's not going to bode well for the gold. So as you can see, gold was overbought. The stochastics momentum is down. MACD is about to cross. The only thing is we are right sitting on that 18-day moving average. So we hit the Bollinger Band, and basically we are sitting right on the 18-day moving average. But when we look at the weekly, we can see, again, this is a crucial point that that 100-week moving average comes into the picture. We are oversold, so we might have a little bounce, especially as I mentioned, with a little rest on interest rates and with a rest in dollar, we might have a bounce. But really, gold hasn't given us any type of a buy signal yet, so it is in a weak spot at this time. Silver has been even more so. Silver has been, this is not a very pretty chart, because you can see we got rejected at 100-day moving average, and basically there's a good chance that we will hit the lower edge of the Bollinger Band. So it's not boding well for the mining stocks, and we're just hitting the oversold area, but the MACD also has moved to the negative side, and that's the trend is down. So we need to stabilize. So this is not time to be hero and start buying at this time, but I would just watch to see if there's any signs to go long, but not yet. And the copper is in a similar situation. With copper, you can see that we are MACD up negative, our stochastics negative. Copper went and hit that 100-day moving average, got rejected. We've done it a few times. We've done it since we're going back to April. Once we broke down, it has been the problem. Obviously, China plays a big role, and copper is important to watch, especially if you're investing in emerging markets, and it's a very important commodity. So when we look at on a weekly basis, you see that 100-week moving average has produced a very strong resistance, and we've been below that, and since we broke down last year. So we just hit that Bollinger Band, so we might have a little rest. But again, there's not, MACD is pretty flat. It's not giving us any indication. So there's not much strength showing at this time. And talk about the strength. Now, Bitcoin, as you can see, once we broke that 100-day moving average, the Bollinger Bands, once they expanded, that gave us the sign that we are in a weakness. We tried one time to hit that 18-day moving average break above that. We couldn't. So we've gotten really in a weak position. We look at the stochastics are embedded, so that's more weakness. MACD is, the trend is down. So although we are sitting in some consolidation at this time, but really there's no buy signal, and of course the dollar also plays a role in that. And looking at the strength in the crude oil. Now, we have discussed this, I guess, in the beginning of the year. I mentioned, for me, 70 to 90 area was the area zone for the for crude oil, although there's a talks of 100. I'm not too sure about that. Right now, we are kind of overbought. You see, we went over the Bollinger Bands. We corrected it, but we are embedded. So what the embedded mean, and MACD is up, what does that mean is this is not time to short the crude oil. So there's a lot of strength. And basically what it does, it just needs consolidation. So it's okay to take some profits, but no time to short it. As you can see, the Bollinger Bands are expanding. We are nicely above the 18-day moving average. So there is that strength. It's just we were above the Bollinger Band. You can see 1, 2, 3, 4. And generally, we cannot go more than 5 bars or 5 days. So that's what we just did. We came inside. So, but there's still strength. But as I mentioned, I think 90 presents resistance at this time. As far as when we look at another energy segment is natural gas. So I'm looking at on a weekly, and what you can see, we are coiling. Momentum is down on a weekly. MACD is in flat to up, I mean, on the positive side, but we are coiling. So the longer this goes, the bigger the move is going to be. You can see it here, and we've had that many times now. It's been pretty hot in the south and a few areas. So, but October and November are coming. So, natural gas is something I would encourage you to watch just from the charts point of view. Another thing that's been interesting has been the sugar. It hasn't. You can see that we were coiling with sugar, and then we did have a nice bounce, and obviously it has fundamental reasons for this as well. But we've talked about sugar. It was one of the things I think a few months ago I encourage you at least playing the ETF. It has had strength from the commodities point of view. But one of the reasons for this big move, obviously, is the weather. We've had the drought in Thailand, and that has been a culprit. But you can see we're still embedded with the stochastics, and MACD is in the positive sign. So it's just a food for thought, to revisit. All right, let's talk about, we talked about volatility, this expected move, which we go over every week. And this is from the option players, or basically they are algos that they run this, is the probability. And look what happened this week. We did go, S&P did go outside this lower edge of the expected move. Now, I mentioned about VIX, and once you look at VIX, you might say, wait a minute, that's such a low volatility, so not much is happening. We got is pretty much in doldrums. But look how many times we've gone outside our expected move on VIX. So you see we've been out there, we've been out here, we've had like 3 or 4 days last week, we've been out 2 days. So really this drives the market makers crazy in option market. So basically that tells us that intraday and short term there is a lot of volatility being played, and that doesn't bode well for the markets in the long run. So just be aware of that. So it was a short week, by the way. We only had 4 days. So for next week, I think it's like about $46 move on S&P. The same thing once we look at NASDAQ, we respected the lower edge of expected move. And but when we come to Russell, the small caps, you can see we were almost 2 standard deviations outside the expected move. So that tells you how drastically the move was. And the Dow bounced off the lower edge. And then we look at the bonds, they respected their lower edge. And then the dollar respected the upper edge, even though we did go outside, but we are right on the edge. And the same thing happened with gold. We respected the lower edge. And then on the other hand, silver, as I mentioned, it has been wild ride. We've had a beautiful move, and then now the chart doesn't look good. The gold-silver ratio favors gold. So if you're bullish at this time, gold has a better play than silver. When we look at the financials also respected their lower edge of expected move. And then energy, beautiful move we've had. We talked about crude oil, energy sector. You can see how nicely we respected the upper edge of the expected move. Now, since I wasn't here last week, I thought, as always, every month we look at the performance of the different assets. So for the August, you can see sugar and orange juice and cocoa were the leading performers. For the year to date, you see the orange juice is up 78% at end of August. Sugar is up 43, and cocoa is up almost 40%. NASDAQ of all the financials is up about 37. You see oats and Nikkei, Japanese markets, gasoline, and feeder cattle. Now, the worst performer is the VIX, the volatility in natural gas, and the palladium, wheat, and corn. So these are the year to date. When we look at the sectors, we can see that the defensive sectors, such as consumer defense and utilities, have been the worst performers, and for a good reason, because the money has gone to more of aggressive sectors such as communication and also the technology. So now this past week, you could see the money actually move to the defensive and consumer defensive and utilities. And also you see the healthcare is another defensive sector. So the money moves there. That shows that a little concern with the markets. But other than that, you can see that for the month, the consumers, the communication services and technology, they still were positive, but also energy did well. As far as for the month, for August, the best performing industry was in the uranium, and then utilities and communication equipments and thermal coal. When we look at the year to date, the semiconductors are big winners still. So, and then you can see the auto manufacturers are up almost 62%. As far as the individual stocks in S&P, for the month, Apple was down, yet we can see Eli Lilly in healthcare had a beautiful month. Google was up, Nvidia, Microsoft was flat. And then when it comes to year to date, you can see this is as of end of August, all the big horses from Google to Microsoft to Amazon, Tesla, Apple, all the big horses which have carried the NASDAQ and S&P. As far as the ETFs, you see again, the financials in the sense of, financial indices, but like the S&P and NASDAQ, they've done well, while the diamonds, the Dow Jones, because of the presence of like financials and industrials, they've been laggards. And then this is the semiconductors have done very well. As far as the world goes, this is for the month. You can see they're not a lot. So Asia, especially when you look at the China, there's a lot of red. Japan had some green. And then when we look at the year to date, then obviously there's some good buys. Canada has, their banking system, their banks, you can see there's a lot of negative numbers there. So, all right, so let's discuss got a few things about emerging markets. This is as a Wednesday. You can see still a lot of world markets are in a nice positive returns. Very few are in the red. China and Great Britain just got flat. And then you have Hong Kong and Thailand, and Singapore is flat. But other than that, you can see Argentina being up 189%. That's basically on a local currency. But a lot of markets are in a positive, although this week we see quite a few negative ones on a weekly basis. As far as the ETFs, these are the 2 monthly charts. You can look at the ETH and emerging markets. You can see on a 2-month charts a lot of weakness because of, again, August and now September. So when we look at the strength, we see India is the strongest market, and then other than that, basically all other markets are following this kind of a similar pattern. Malaysia is sitting on their 50-day moving average, and then Japan just sitting on its 50-day moving average as well. But again, it's August and September. August is usually a quiet month, so basically I see the weaknesses. I talked about the energy sector, and of course, Canada being one of the largest oil producers. We've talked about currencies. As you know, a lot of commodity currencies follow the commodities, and what I mean by that, countries like Australia or Canada, for instance, which are very much dependent on natural resource and the commodities, the currency becomes stronger when the commodities get stronger. Now, this is interesting in Canada right now, that a lot of Canadian energy companies are having a double whammy. And what I mean by that is, as you could see, the oil prices are going up, but the dollar is also strong. So the Canadian dollar has actually gotten weaker. Now, what happens to these energy companies? They're getting paid in dollar or US dollar. So not only the energy prices are going up, or the crude oil price going up, but also they're making money because of their, again, the US dollar. So that has boded well to the Canadian energy companies. We talked about China. So the China, we could see that the consumer prices, they tiptoed out of deflation territory in August, and they rose finally by 0.1%. And in July, they had fallen 0.3%. So that was important, but also the producer price deflation eased from 4.4 to 3%. So, that's, remember, there's this property crisis in China, and that has been affecting, obviously, when we talk about some of the industrial materials, we talk about, let's say, copper. So that has affected that. Speaking of crude oil, we want to look at some of the exporting companies or the oil producers and see what is their break-even oil price. So what are they favoring? And as you can see, United Arab Emirates at $55, that will put them black, and they are in black. So when you look at $88, that's a pretty good profit margin. Iraq is at 76, and Saudi is at 78. On the other hand, some of the Central Asia, you see Turkmenistan and Qatar and Libya and Kuwait. And then now we get to Kazakhstan, Algeria, Bahrain, and look at Iran with all the sanctions, and they're selling their oil which much cheaper. Their break even to have a healthy economy, and this is $364. So it's important to pay attention to these and see where that those price controls come. Speaking of United Arab Emirates, we're talking about Dubai. Now, Dubai's equity index, they've had a really nice move, but also the valuation has gone up in past 6 years, and they are the price to book value is at 1.35, which is 35% premium for the 5-year median, and along with their real estate movement. So it has gone up. It has been, it has been productive for them. But what could go wrong? So once we look at Dubai, there's a few things you want to take into consideration. The higher interest rates globally can affect them, especially with the US and the inflation. The OPEC plus unity could break down because it's always fragile. How about the reversal in the Iran's that obviously, as you know, next week is the anniversary of, what happened a year ago with the uprising. So that's a concern. What could Iran, what could happen in Iran? And these are the anti-money laundering actions in FATF, and then also the competition for the hub activities from Abu Dhabi and Riyadh, which affects Dubai. So and again, the regional tension. So there's geopolitics involved, but just a food for thought when we are looking at a place like that. As far as you know, President Biden went to India. We have the G20, and they were meeting obviously in Delhi. Now, what we don't see is Vladimir Putin of Russia and President Xi from China. They are not going to be there. So, but it is important to know that it's a important meeting. And again, India is trying to take a big leadership in that. Obviously, they are elected this year. They are hosting this, and basically, but they want to have the voice of reasons. We talked about the BRICS and the inclusion of the 6 new countries, including Iran, part of the BRICS. And I want to pay attention to this, that, Prime Minister Modi invited the African Union to become a permanent member of the group, which that will bolster India's claim to be a leader of the poor world. Of course, Xi and Putin are not there. So basically, India is trying to take that leadership. And we've talked a lot about Africa. Just a little, again, education on what is G20 is, Intergovernmental Forum comprised of 19 sovereign countries and the African Union and the European Union. So, and then every year there's a chair rotation. Now, remember, these countries, which they include developing and developed countries, accounts to around 80% of the gross world product and 75% of international trade. So you want to pay attention to that. So basically, these are the groups and the members, and who becomes the chair. There's a rotational. As you can see, we're in the group 2. India is the chair for this year. And then for 2024, the Brazil will be, and then South Africa will be in 2025. Another interesting chart I thought that would be interesting from Bloomberg. This is the first time U.S. is importing more from Mexico than China since 2003. So that was also thought that was interesting. Not changing it from the from the economics to geopolitics to politics. As you know, there's been, with the elections coming up in the United States next year, there's a lot of talk about President Biden and his age. And of course, right now, which is a very interesting, actually it's a dichotomy, seeing that his opposition could be ex-President Trump, which is not not a youthful age either. So there's been discussion about the ages. So I thought this could be an interesting to see the leaders of the world, especially in emerging markets, and just compare them. So you can see that how many years they've been in power. Now, Mahmoud Abbas, from Palestine, is 87 years of age, but the median age difference is like 66 years between Palestine leader and it's the median age of this group. So when you come to United States, President Biden is 80, but he's 42 years older than the median age. You can see Iran is the Ayatollah Khamenei. He's 84. He's been in power for 34 years, which is basically the longest of all the countries in our in our chart here. And he's 52 years older than the median age of the Iranian population. Or Ghana is like 57, or you see Ivory Coast is 62. So anyway, this is just a little chart. Just thought it might be of interest. You can see the Saudi, on the other hand, is 38, and basically Mohammed bin Salman, which has had some drastic moves. So That was interesting. And also, there's been, our connection with Africa. We'll talk a lot about Africa, and obviously, it has been a very difficult continent to pick and choose investments. Although there's tons of money going there, there's a lot of support, but things like this from the geopolitical side, which makes the hesitation in really fully going and really committing complete commitment, actually. So we've had quite a few coups going on, and these are just the recent coups. You could see, remember, Niger was a big thing talked about in July, and now we have Gabon. Attempts have been in Sierra Leone and in Sudan, and so basically, like in Gabon, was like a 55-year proposed leader, so he was in power for 55 years. So it's important to pay attention again to geopolitics as far as the valuation of, if you want to invest in these countries in Africa. You can see Kenya offers some of the most attractive valuation as far as based on price to book and price to earning. Going to the physical health, if you want to be productive, you have to have your sleep. So I thought, on a side note, we want to see which countries get the best night's sleep, and it looks like New Zealand has the best sleep efficiency, or it has the best one of the top as far as the time spent sleeping hours. So these are the top 10. And basically also the catching the Z, which countries they go to bed the latest or the earliest, and they wake up the earliest. And you can see South Africa, they are the early birds, and then and so on. So you can see Russia, they go to bed the latest, and then they wake up the latest. So it just another chart that's for you. Speaking of Russia, since the Ukraine invasion, I thought this also is interesting. Russians have immigrated in huge numbers since the war in Ukraine. And you see Kazakhstan, Serbia, and Armenia and Turkey have been the biggest recipient of the immigration. And this is the annual new immigration from 1990s. Of course, we had the fall of East. So basically, that's just a little chart to show you. All right, just a few little lessons about lessons of the week. Seasonality, I mentioned this goes back for the past 25 years. As you can see, September is the worst month for investing in the stock market for S&P. There's always an exceptions, but August proved to be right, and September is right. We've had the last time September was up was in 2019, which was the year before the election. So this year is the before election, just a reminder, but generally September is a weak month. Speaking of that, so for the next month, you can see September is in the 9th percentile in the past 100 years as far as being best. But for the next 3 months, after that, what we see is one of the best times. So once you start investing like end of September and then invest in October, November, December, that's like an 87th percentile. So that's from the seasonality. Now, this was interesting that once the oil goes up, value and to a lesser extent, small caps tend to outperform when oil prices rise. And there's a good reasons. A lot of energy companies, they are more of a value, they pay dividends. And so just an interesting chart to show you the relationships between the oil and the stocks. The last but not least is more of on the economy. Now, the total household debt balance increased by $16 billion in the second quarter of 2023. Now, this comes from the New York Fed Center. The credit card balance also saw the largest increase of all debt types, 45 billion, and stands at $1 trillion. That's surpassing the $1 trillion in the first time in its history. So we've talked about this, and I think that was a concern that came out. Right now, it is not as big of a concern because it's said there's, when you have a 3.6% unemployment, the economy is looking okay. But the minute things go wrong, this is going to have a big effect. So I just want to give you a heads up. Also, the Fed's measure of credit card debt 30 or more days late climbed to 7.2% in second quarter, which was up 6.5% from quarter one, and the highest rate since the first quarter of 2012. And the total debt delinquency edged to 3.18%. The number of people who made hardship withdrawal during the second quarter also surged from the first 3 months of the year to 15,950, which is an increase of 36% from the second quarter of 2022. So these are the people who want to take money out of their, like a 401k and other things. Last quarter in Texas and Wyoming, more than 25% of the car shoppers committed to a payment of more than $1,000 per month. So again, it shows, the economy is okay. So people are committing this, but you want to be aware of this. So anyway, that's just part of our lessons. I quickly go in interest of time. I really appreciate you being with me and with us. As you can see, the gaps, again, we filled it on a 5 minutes. We have a small gap from Wednesday. So just pay attention to that. When we look at the long term, we can see that that small gap on the 60-minute, everything else has been filled since August 14th, since I left. So all the gaps are filled. So this is, again, and you can see here, the power of our gap trade. So pay attention to that. As far as ETF of the week, we have, we talked about oil and gas. So XES was up 4.9%. The small cap information technology was down 6.3%. Also, we had the oil equipment services was up 4.4%. Invesco Solar ETF 10 was down 5.3%. As far as the stocks, just wanted to review our Tesla. We've been doing it for the last 5-6 months. They did have the earnings. You can see we had the gap down. We were above the Ichimoku cloud. We broke below this turning line, the standard line, and we went. And look what happened. We went right outside the lower edge of the cloud and we came back. So we are in a neutral zone, although you can see the DMI negative was giving us the heads up when that happened. Now we are in a very neutral zone with ADX, below the 20. So we really don't have the big trend. But if you were gonna, this is not the right time to short the Tesla anymore. I mean, would have been good right here. So we are right in a neutral zone. Apple again played a big role with S&P. You can see again the DMI gave us a heads up, and this is not boding well. We broke below the cloud, and this is really Apple you have to watch. Although again, generally what happens, we are having the new product, I think it's next week. So be aware of that. Generally the markets drop on the day of the product and then bounce back. So maybe the market is looking ahead besides the China story. So be aware of that. On a weekly basis though, we still not in an, we're still strong. We're above the standard line. We are above the cloud. We are right under the trending line. So on a long term, Apple still strong long term, but on the short term, we have weaknesses. So just that. As far as a squeeze candidate, that shows the Dow Jones Industrial. And so we have these three candidates. If you want to do a little more research on the squeeze, the last but not least, we still got some earnings. We got Oracle, we got Adobe. These are the big ones. So Adobe is expected to beat the earnings. So they've done, obviously, it looks a really nice chart. And Oracle and the fuel cell are the other ones. So in a nutshell, this is what's going on. I hope it was helpful and useful. I appreciate you being part of our group. And what I'm going to do, I'm going to stop the recording and then open up for Q&A. So let's stop the recording.